There are old traders, and there are bold traders, but there are very few old bold traders. Many think bigger risks equal bigger rewards, and in trading, that belief destroys more accounts than anything else. Swing harder, win bigger. It's how we're wired. But in trading, that belief destroys more accounts than bad analysis, more than terrible timing, more than emotional decisions, more than all of that combined. Let me ask you a question. When you look at your account after a massive win, what do you see? You see the money, you see the percentage, but you're missing the most important piece of information, the risk you took to get there, the luck you needed to survive. In this video, I'm going to show you why the aggressive approach feels so right, but consistently fails. Real stories of traders who learnt this the hard way. The psychological trap that keeps you doubling down when you should be pulling back. And what actually separates the winners from everyone else. The 1% rule. Why trading like a boring person is the only way to make real money. Not financial advice, just education. Let's get into it. Let's start with the thing that wrecks most traders in their first year. You've heard it before. Risk only 1 to 2% per trade. And you probably thought, yeah, right. But that's for people who are scared. I'm here to make real money. I didn't get into trading to play it safe. I get it. It sounds boring. It sounds like you're leaving money on the table. Here's the problem with aggressive trading. When you risk big, let's say 10% per trade because you have conviction, a bad week absolutely destroys you. 5 losses in a row, and you've lost almost half your account. You're sitting there, staring at a balance that's been cut in half. And the psychological damage is even worse than the financial damage. You're not thinking about making money anymore. You're not looking for opportunities. You're thinking about getting back to break even. And that's a completely different mental game, with completely different emotions. The safe trader, who risked 1% per trade, 5 losses barely dent them, they're down 5%. They're annoyed, sure, maybe frustrated. But they're not in a black hole. They're still playing offense, still looking for the next good setup. One trader is trying to survive, the other is still trying to win. That's the entire difference. Right there. And here's what makes it even worse. The math of ruin. Getting back to even from a 50% loss requires a 100% gain. You have to double what's left just to break even. The safe trader losing 5% needs a 5.2% gain to recover. One trader needs a miracle. The other needs a decent week. Math has no mercy. Let me tell you about Jesse Livermore, because his story perfectly captures what happens when position sizing goes wrong. In 1929, Livermore became a legend. He shorted the market right before the crash and made the equivalent of about $1.5 billion in today's money. Think about that. He was one of the most famous traders in the world. People wrote about him. Other traders studied his every move. He was the guy who had figured it out. 5 years later, he declared bankruptcy. How does that even happen? How do you go from effectively being a billionaire to broke in 5 years? He got sloppy with his position sizing, started taking massive positions when he felt certain about a trade. He confused a winning streak with being invincible, started thinking the rules didn't apply to him anymore. The market humbled him brutally. And he ended up losing everything. Not once, but multiple times throughout his life. Before he died, he wrote something that still haunts me. My life has been a failure. Think about that for a second. The man who once controlled enough capital to move entire markets, who made more money in a single trade than most see in a lifetime, died broke and destroyed because he couldn't stop betting too big. That's not a strategy problem. It's not a market analysis problem. It's a survival problem, and it's the same problem that kills retail traders every single day. Here's what happens when you trade aggressively, and this is important because it explains why smart people keep making the same mistakes. You risk big, and you win. Your brain floods with dopamine. It feels incredible. You feel like a genius. You feel invincible. And you want that feeling again. So, on the next trade, you go even bigger. Why wouldn't you? You just proved you can do it. Then, you lose. And losing hurts way more than winning feels good. This isn't just a saying, it's actual neuroscience. The psychological pain of losing is about twice as strong as the pleasure of an equivalent win. So now you're in a hole, and your brain is screaming at you. Screaming to win that money back immediately. You can't think clearly. You can't be patient. You just need to get back to even. So you size up even more. Trying to recover in 1 or 2 trades. This is called revenge trading, and it's how most accounts actually die. Not from a bad strategy, not from poor analysis, from emotional decisions driven by position sizes that are too large. Boring trading, safe trading, removes you from this entire emotional nightmare. When you're only risking 1% per trade, your emotional response is muted. A loss is annoying, not devastating. You're not in a downward spiral. A win is nice. But you're not getting high on it to make stupid decisions on the next trade. You stay clear-headed. You stay rational. And in trading, rationality is literally everything. The market doesn't care about your emotions, but your emotions determine every decision you make. I knew 2 guys who started trading around the same time. Both had $25,000 to start. Both studied the same YouTube channels, read the same books, practiced on the same simulators. Both were pretty decent at identifying setups. On paper, they were the same trader. Trader A wanted results fast. He was tired of his job, tired of the grind, and he saw trading as his ticket out. So, he risked 5% per trade. Because he wanted to make things happen, he needed bigger wins to justify the time he was spending. After 6 months, his account was down to $8,400. One particularly bad month almost wiped him out completely. He was stressed all the time, couldn't sleep properly. His girlfriend noticed he was always on edge, constantly checking his phone. Trading was consuming his entire life. And not in a good way. Trader B took a different approach. Risked 1% per trade. Trader A called it boring money. Said he'd never get anywhere trading that small. But Trader B didn't care. He had a day job he didn't hate. And he was just focused on being consistent. 6 months later, Trader B's account was at $31,200. Nothing spectacular happened. No massive wins to screenshot. No huge days. Just steady, boring growth. Here's what really matters though. Trader B slept fine every night. His worst drawdown was barely noticeable. Something like 6%. A couple of bad weeks. But nothing that kept him awake at night. Trader A's account got cut more than in half. Twice, his relationship suffered. He snapped at his kids over nothing. He was drinking more. Trading wasn't making his life better. It was destroying it. A year later, Trader A quit, told everyone that trading was too stressful, too risky, and probably a scam anyway. Convinced himself the market was rigged against retail traders. Trader B is still trading today, 5 years later. With a 6-figure account, he eventually quit his day job, but not until his trading account was large enough to feel safe. Same strategy, same market, same starting capital, different position sizing, completely different lives. Let's talk about volatility. March 2020. The pandemic hits and markets absolutely lose their minds. I'm talking total chaos. Stocks moving 20, 30, sometimes 40% in a single day. Circuit breakers getting triggered. The VIX, the market's fear index, spiking to levels we hadn't seen since 2008. If you were risking 10% of your account per trade, and you were on the wrong side of one of those moves, you could lose 40% of your entire account in hours. Not your position, your whole account. Because stop losses were ignored. Slippage was insane. and the volatility was eating people alive. I watched it happen. People who thought they had tight risk management suddenly had positions going way past their stops because the market was moving too fast. The boring traders, the ones risking 1% per trade. They took hits too, don't get me wrong, but a 30% move against a 1% position is a 3% hit on the account. Painful, yes, but you're still in the game. Here's the really brutal part. That crash only lasted about a month, maybe 6 weeks. Then markets started recovering, and they recovered fast. If you survived that initial drop, the opportunities on the way back up were incredible. The safe traders survived and made fortunes on the recovery. Some of them had their best months in years. The aggressive traders were already out, sitting on the sidelines, with blown accounts, watching everyone else get rich, trying to figure out how to save enough money to get back in. Volatility doesn't care how confident you are. It doesn't care how good your analysis is. It just eats aggressive position sizes for breakfast. You want to know what real professional traders risk per trade? The ones managing millions and billions of dollars. Most risk between 0.5 and 1% per position. That's it. The really successful hedge funds and prop trading firms. Some of them go as low as 0.25% on individual positions. Let that sink into your mind. These are people with entire research teams, advanced algorithms, real-time data feeds, decades of experience, access to information retail traders will never see. And they're playing it safe. Why? Because they've learned something that retail traders refuse to accept. Staying in the game is more important than any single trade. Survival is the prerequisite for success. Paul Tudor Jones has been absolutely crushing it since the 80s, one of the greatest traders alive. His golden rule: if you have a losing position that is making you uncomfortable, the solution is very simple: get out. That only works when your positions don't terrify you, when you're risking 10% per trade. Every position is terrifying. You can't cut losses quickly because every loss is devastating. So you hold and pray, which is how small losses become accounting disasters. Here is something that doesn't get talked about enough, and honestly, it's one of the most important concepts in trading. When you take a massive loss, you're not just losing money, you're losing time. And time is the one resource you absolutely cannot buy back. Say you lose half your account. Even if you're genuinely good at trading, even if you're getting solid, consistent returns, getting back to where you started takes years, literal years of your life. Just trying to get back to break even. If you lose 10% of your account, you recover in months, but there's an even deeper cost. Opportunity cost. Every month you spend recovering from a massive loss is a month you're not compounding. A month where your money isn't working for you. If you blow up your account and it takes you 2 years to get back to where you started, you didn't just lose 2 years of time. You lost 2 years of compound growth, 2 years of market opportunities, 2 years where you could have been building real wealth. Aggressive trading steals your time, and time is the one ingredient you absolutely need to build wealth. You need years of consistent compounding. You need to be in a market with capital when opportunities show up. Every massive loss sets you back years, and most people don't have decades to keep restarting. But what about those massive wins? What if I catch a trend and the trade goes 10 to 1 in my favour? I hear this all the time. It's the main argument for aggressive sizing. And I get it. It's seductive. Risk 1% and catch a trade that goes 10 to 1. You make 10% on your account. Nice win. Risk 10% and that same trade makes you 100%. You double your money in one trade. That sounds way better, right? Except here is the reality. You will never make it to that trade. The losses along the way. And there will be losses, even for the best traders. will have already destroyed your account before you see that 10-to-1 winner. Think about it. To even get the opportunity to catch that big winner, you need to take dozens of trades, maybe hundreds. And during that journey, you're going to hit losing streaks. Everyone does. It's just part of trading. If you're risking 10% per trade, a normal losing streak ends your account before you have the chance to hit that big winner. Safe trading keeps you in the game long enough to catch those trends. Because they do happen, but only if you survive long enough to take the trade in the first place. The aggressive trader is mathematically eliminated from the game before they can benefit from the upside. I watched this happen in real time, and it's burned into my memory because of how quickly it occurred. There was a guy in a trading Discord I was in, started with $50,000. He was actually pretty good at identifying setups. He was crushing it for about 2 months. Took his account to $71,000. Then he got arrogant. Started talking about how he had figured it out. Started posting screenshots of his daily P&L. Started risking 8% per trade. Because, in his words, when you know, you know. Then he hit a rough patch. 5 losses in a row. It happens. His account dropped to $45,000. And this is where it gets ugly. He panicked. Started posting in the Discord about how he needed to make it back. Started risking 15% per trade to recover faster. Said he couldn't afford to recover slowly. 3 more losses. Account dropped to $26,000. Now, he is completely desperate. Started taking trades that didn't even match his strategy. Risking 25% per trade on pure emotion. 6 weeks after his peak of $71,000, his account was under $3,000. He posted one last message, something about how trading was impossible for retail traders, and then he disappeared from the Discord. I think about him sometimes, because he was actually good at trading. His setups were solid. His analysis was correct. But none of that mattered once he entered the death spiral. This is the pattern. And I've seen it dozens of times. A large position size leads to big losses, which leads to an even larger position size to try and recover, which leads to catastrophic losses. The death spiral. Safe traders never enter it. They can't. Because they never take that first devastating hit that starts the panic cycle. When you know that no single trade can hurt you. Everything about your trading improves. You're not hoping. You're not praying. You're not staring at the chart sweating, moving your stop loss because you can't afford to take the hit. You just execute your strategy. Take the trade. Manage it according to plan. Move on. This psychological freedom improves every aspect of your trading. Your entries are cleaner because you're not doubting. Your exits are more precise because you're not emotionally attached. You follow your rules because there is no reason not to. Aggressive traders can't do this. They're too emotionally invested in every single trade. When you have 10% of your account on the line, you can't be objective. You start seeing what you want to see. You move your stop loss because you need this trade to work. You exit winning trades early because you need the dopamine hit and the relief. Their strategy might be fine, their analysis might be solid, but their psychology is destroyed by their position size. And here is what really matters. This psychological edge compounds over time. Every trade you execute perfectly builds confidence. Every time you follow your rules exactly, it gets easier the next time. You're building a track record of discipline. You're proving to yourself that you can be trusted. The aggressive trader is building a track record of panic, hope, and regret. Even when they win, they're reinforcing bad habits. The win was stressful, so the next trade is stressful. The cycle never ends. Over months and years, the psychological gap between these two traders becomes massive. One is calm, confident, and consistent. The other is anxious, impulsive, and erratic. Same markets, same opportunities, completely different experiences. Warren Buffett has 2 rules for investing. Rule number 1, never lose money. Rule number 2. Never forget rule number 1. It sounds simple, almost too simple, but look at his actual track record. He's been investing for over 70 years. His worst drawdown, the most he's ever lost from a peak, was about 50%. And that was during the 2008 financial crisis, when the entire global financial system was collapsing. Most years his drawdowns are small, single digits. He's not trying to hit home runs every quarter. He's not swinging for the fences. He's focused on not striking out. And because he never strikes out, he can keep compounding year after year, decade after decade. The same principle applies to trading. The traders who become wealthy aren't the ones trying to knock the ball out of the park. They're the ones who stay in the game long enough for compound growth to do its thing. And compound growth only works when you aren't constantly digging your way out of massive holes. Let's be practical and realistic here. No hype, no nonsense. You start with $10,000. You're decent at trading. Nothing special, just consistent. You're not catching every move. You're not a math genius. You miss a lot of trades. You take some losses. You're just a normal person who learnt to trade and respects risk. You risk 1% per trade. You're slowly growing your account. Some months you're up 3%. Some months you're up 8%. Some months you barely make anything. Some months you're down a bit. But over time, your trend is upward. Year 1. Your account grows to maybe $14,000. It doesn't change your life. You still keep your day job. Year 2. You're at $20,000. It starts to feel real. Year 3. You're at $30,000. Now you're paying attention. Year 4. You're at $47,000. Your friends are asking how you did it. Year 5. You're looking at $75,000. Maybe more if you had a good year. These aren't lottery ticket numbers. But this is real wealth being built. And it's sustainable. You're not stressed. You're not losing sleep. You're just consistent. Run the same scenario with aggressive trading. Most don't make it to year 2. They blow up in year 1 or maybe early year 2. The ones who manage to last longer are usually rebuilding from a blown account, learning the same painful lessons over and over again. By year 3 or 4, they're exhausted, burned out, convinced that it doesn't work. Meanwhile, the safe trader just keeps compounding year after year, while everyone else is starting over. They're building true, lasting wealth. It's not exciting. Nobody is making YouTube videos titled, "I made $47 this week trading boring." But it works. And it works because it's sustainable. Every time you blow up and have to rebuild, you miss the best opportunities in the market. Think about the pandemic recovery. Think about the AI boom in 2023. Think about whatever the next big thing will be. Those moments happen whether you're in the market or not. But you only benefit from them if you're actually in the game with capital. When you're sitting on the sidelines, broke, trying to save enough money to fund another trading account, those opportunities pass you by. I watch traders blow up 3 or 4 accounts in 5 years, constantly restarting, constantly rebuilding, constantly missing the big moves because they're out of the market. If they had traded safely from the beginning, they would be sitting on life-changing money right now. Instead, they're back where they started. Or worse, bitter, cynical, convinced that trading is a scam, telling everyone it doesn't work. But it's not that trading doesn't work. It's that aggressive trading doesn't work. The game rewards people who show up consistently, not people who show up occasionally with bags of money and a dream. Market opportunities don't wait for you to rebuild. They happen while you're sitting out, broke, trying to figure out how to get back in. And by the time you're back in a market, the opportunity is gone. Now, let's turn all of this into a simple process. A framework you can use starting tomorrow to reprogram your brain. 5 steps to trade small, survive, and dominate. Step 1. Audit your emotional risk, not just your financial risk. Before your next trade, ask yourself this: if this trade hits my stop loss, will it ruin my day? Will it put me in a bad mood? Will it make me want to take another trade immediately to get revenge? If the answer to any of those questions is yes, your position size is too big. Cut it in half. Keep cutting it until the answer is an absolute boring no. Step 2. Shift focus from the trade to the series. Stop looking at individual trades. Start looking at series of 20 trades. One trade means nothing. It's just noise. When you risk 1%, you force yourself to think in the series, because you know one trade won't make you rich or leave you broke. You detach from the immediate outcome and stick to executing the system. Step 3. Embrace the slow growth phase. Understand that the first 2 years are not for buying a Lamborghini, they're for building the discipline muscle. If you're making $50 a week with a small account, don't laugh at it. You're testing your system. You're proving that you can follow rules. The capital will eventually come to you when you're ready. But if you can't manage a $1,000 account safely, you will destroy a $100,000 account in a month. Step 4. Calculate the math of the worst-case scenario. Take your current system. Assume you will have a losing streak of 8 trades in a row, because you will. With a 10% risk, that's minus 80%. You're done. With a 1% risk, that's minus 8%. A normal pullback. Look at those numbers every time you feel the urge to size up. Step 5. Find your dopamine in the execution, not the outcome. Your brain wants a reward. Give it one. But change the source. Don't celebrate when you make money. Celebrate when you followed your trading plan exactly. Reward yourself for cutting a loss quickly at 1%. Take pride in being disciplined. If you change what your brain perceives as a win, boring trading becomes your greatest satisfaction. 5 steps. Audit emotion. Think in series. Embrace slow. Calculate ruin. Reward execution. That's the framework. That's the difference between those who play to gamble and those who build careers. Trading isn't about having the perfect analysis or finding the magic indicator. It's about managing risk in a way that allows your statistical edge time to play out. If this video helped you finally see the illusion behind massive risk, let me know in the comments. What has been your worst over-leveraging mistake? Leave a comment. I read every single one. I'll see you in the next video. Stay disciplined. Stay boring.